All right, we need to talk about a report that is sending some serious shockwaves through the entire world of digital assets. The bottom line is this: a global compliance crackdown isn't on the horizon, it's already here. So let's get right into it. You've heard it a million times, right? For years, crypto has been called the Wild West of finance. And that brings up a really big question, one that this new guidance is forcing all of us to ask: is that era finally, truly coming to an end? Well, it looks like the answer is a pretty clear yes. So, who's the new sheriff in town anyway? Well, meet the FATF, or the Financial Action Task Force. The easiest way to think of them is as the world's financial watchdog. Now, they don't write laws for any single country, but they set the global anti-money laundering standards that pretty much everyone agrees to play by. And right now, crypto is square in their crosshairs. Let's break down exactly what this global watchdog is saying, and maybe, more importantly, why its focus has become so incredibly sharp when it comes to the world of virtual assets. Okay, so this all kicked off with a brand new update that dropped in February 2026. And this wasn't just some routine paperwork. No, this was a deep dive review into how well countries and crypto companies are actually following the rules. And what they found, well, it wasn't exactly a glowing review. In fact, you can really think of this entire report as a global report card for the crypto industry's compliance efforts. And spoiler alert, it looks like the whole industry is seriously at risk of failing. Look, there's no way to sugarcoat this. The main takeaway is incredibly blunt. The FATF concluded that, on a global scale, the actual implementation of these crypto rules is, and I'm quoting here, dangerously weak. Now, that's a word global regulators don't just throw around lightly. And here it is, the report card itself. Just take a look. Whether you're talking about the travel rule, how crypto exchanges or VASPs are supervised, or the risks coming from stablecoins and unhosted wallets, just look at that column on the right. High, 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 and high again. This is not one isolated issue, folks. This is a systemic problem. So, why the failing grades? Well, the report zeroes in on 5 critical gaps in the world's financial defenses. Let's dig into them one by one. First up, and this is a really big one, is the travel rule problem. This has been a huge point of focus for regulators for years now, and the industry is just still struggling to get it right. So, what is the travel rule? Honestly, it's pretty simple. It just means crypto exchanges need to collect and share info about who's sending and who's receiving the funds, just like banks do for wire transfers. The problem? While tons of countries have passed laws requiring it, they just don't have the teeth to enforce it. The technical systems from one exchange to another often don't talk to each other, creating these massive blind spots. And you should know, regulators are basically out of patience. This quote here is a direct warning shot to the industry. Enforcement triggers. What that means in plain English is that regulators are now actively looking for travel rule failures as the reason to launch investigations and hand out fines. The second major gap they found involves stablecoins. It's kind of ironic, right? The assets that were designed to be the safe, predictable part of crypto are now creating a whole new set of massive risks. So why are they so risky? Well, they're super liquid, and you can move them across borders in an instant. That makes them a perfect tool for a money laundering trick called layering, where you move dirty money through a maze of transactions to hide where it came from. Bad actors can use stablecoins to jump between different blockchains and cover their tracks in seconds. And because of that, the expectations have totally changed. Regulators are now demanding that exchanges have monitoring systems specifically built to catch these shady patterns. Things like crazy fast swaps between different stablecoins or jumping funds across multiple chains. Next on the list is the challenge of unhosted wallets. You probably know them as self-custody wallets, the ones where you and only you hold the keys and have total control over your funds. Now, this idea of user control is a core part of what makes crypto crypto. But for regulators, it's a huge headache. It creates a major transparency problem because when a transaction goes to an unhosted wallet, the exchange on the other end is basically flying blind. They have no idea who they're dealing with. The last 2 gaps are really 2 sides of the same coin. It all comes down to one thing: weak global oversight. These are the systemic cracks that let all the other problems get even worse. On one hand, you have simple supervisory weakness. A lot of national regulators just don't have the tech skills or the people to police this industry. And that opens the door for something called regulatory arbitrage, which is basically just a fancy term for crypto firms jurisdiction shopping. They find countries with the weakest rules and set up shop there to avoid strict compliance. Okay, so we've run through the problems, but let's zoom out. Why does any of this matter to the average investor or builder or just user in the crypto space? It matters because this report signals a fundamental change in how the entire global financial system sees crypto. This slide just nails it. The old view? Crypto is some niche, weirdo thing happening on the side. The new reality? No way. Crypto is now officially seen as a core financial risk that has to be managed just as seriously as traditional finance. It's in the big leagues now. And this isn't a friendly suggestion anymore. It's a demand. Every bank, every payment processor, every financial firm is now expected to formally bake digital asset risk right into their main company-wide risk plans. Crypto is officially part of the whole shebang. Which brings us to the final and most important question. Given all these risks and this huge shift in thinking, what's the path forward? What is the future of crypto regulation actually going to look like? Well, the report lays out a pretty clear roadmap. We're talking about much better transaction monitoring, really thinking about the risks of where users are signing up from, and making travel rule compliance a non-negotiable priority for everyone. But the real game changer here is number 4. It's not enough to just have policies written down in a binder anymore. You have to prove they actually work. And that leaves us with the ultimate question for the entire industry, doesn't it? As the rules of the game are being rewritten right before our eyes, the big challenge is to figure out how we balance the incredible world-changing innovation of crypto with the absolute need for global financial security. The Wild West era might be over, but what comes next? Well, that's...
Thank you for watching this lesson. If you found it helpful, please like the video and subscribe for more AML and compliance training. If you would like to earn an anti-money laundering certificate, please visit www.naecacademy.ca. The first course is free and eligible for certification. I'll see you in the next lesson.